Hello, my name is Steve Scott. I'm a forensic manager with IAG Forensics and Valuation, and I'm here with another episode of Behind the Numbers. Today, I'd like to talk to you briefly about business valuation, and specifically those tricky subjective areas with which every attorney needs to be familiar in order to examine an expert. The first area I'd like to address is the reasonable compensation of the owners. Quite often, small business owners may pay themselves less than they should so they can reduce their income tax liability. And then maybe they make it up by paying some personal expenses through the business. Theoretically, if a new owner was to buy the business, they would have to hire someone to do what the previous owner did, and that may cost more than what the previous owner was paying themselves. For that reason, the business valuation expert has to estimate what the previous owner's reasonable compensation should be. This is an area of subjectivity about which business valuation experts may have widely differing opinions. It's important to know that and explore it when you're reviewing a business valuation report, and especially when examining a business valuation expert. The second area of subjectivity for business valuations is the area of specific risk. Every business has risks that are specific to their enterprise. The greater the specific risk, the less the business's value. Opinions on business valuation experts can of course vary when it comes to quantifying that risk. Other areas of subjectivity for business valuations include personal goodwill versus enterprise goodwill. Personal goodwill is specific to the business owner, and it does not transfer to the business or other owners if the business is sold. If that owner were to leave the business, that goodwill would go out the door with them. Enterprise goodwill, on the other hand, is goodwill associated specifically with the company. This type of goodwill is transferable to a new owner. Finally, there are discounts which are applied at the end of any business valuation process. There are two main types of discounts which need to be considered. The first discount is for lack of control. If an owner does not have a majority interest in the business, then they do not have decision-making power, and that makes that owner's interest less valuable than it would otherwise have been. The second discount is for lack of marketability. Purchasing or selling an interest in a small business is not as simple as buying or selling shares of a publicly traded stock. It might take additional time and effort to find the right buyer. And for that reason, a business valuation expert might apply a discount for lack of marketability. Opinions on both types of discounts can vary widely between business valuation experts. If you have questions or would like additional information on any of these topics, please feel free to reach out via email or phone. Again, this has been Steve Scott with another episode of Behind the Numbers.